Liquidity is one of the most powerful forces that drives the market, yet it's also one of the most misunderstood. Traders often struggle with two big questions: which liquidity level is being targeted, and whether price will continue or reverse after hitting it. In this video, we're breaking it all down in 4 simple steps for clear and easy understanding. By the end of this video, you'll have a clear understanding of how liquidity works and how to use it to make smarter entries, and also trade with confidence. So if that's something you are interested in learning, kindly hit the like button, also subscribe to our channel, and turn on the notification bell to stay informed whenever we make new videos. Now, let's get started. Let's dive right into step 1, understanding the different types of liquidity. In trading, liquidity represents areas on the chart filled with either a large number of pending orders or clusters of stop losses. It generally appears in 2 main forms. The first, known as external range liquidity, is found at previous swing highs or lows. These levels are critical because they often determine whether the market continues its trend or reverses direction, forming what we call liquidity runs or liquidity sweeps, which are concepts we will be exploring later in this video. The second type of liquidity is internal range liquidity, also known as fair value gaps. The internal range liquidity is what price uses as fuel to attack the external range liquidity, which are the swing highs and lows. Understanding how price reacts to both forms of liquidity is crucial, because together they provide clear clues about the market's next direction. The second step is order flow. So let's discuss order flow and how it guides us in identifying which liquidity level to target. Now, the first step in analyzing a chart is determining whether the order flow is bullish or bearish, which depends on whether price is moving through buy-side or sell-side liquidity. While this may seem complicated at first, it can be simplified using 2 key concepts: break of structure and change of character. Let's break this down with an example. Each time a new swing forms on the chart, liquidity levels are formed at both the swing high and swing low. The liquidity level at the swing high is known as the buy-side liquidity, while the liquidity level at the swing low is known as the sell-side liquidity. Now, in the context of break of structure and change of character, we focus on which liquidity level was taken out during the formation of the new swing. And in this case, price ran through buy-side liquidity, indicating that the market is currently in a bullish order flow. With this in mind, the current break of structure level is the buy-side liquidity. This is because a break of structure marks the level that must be broken for the existing trend to continue, which in this case happened to be an uptrend. On the other hand, the change of character level is at the sell-side liquidity, since a break of this lower level would indicate a potential shift from a bullish order flow to a bearish order flow. In this case, price breaks above the buy-side liquidity, forming a break of structure and confirming the continuation of the uptrend. Now, with this new bullish swing, a new set of break of structure and change of character levels are established, which we can now use to evaluate whether the trend will keep advancing. Now, here's the big question. How can we tell when order flow has actually reversed? Let me explain. Here we have an uptrend. Normally, we'd expect price to form higher lows for the trend to continue, but instead, price drops and creates a lower low. This marks a change of character, the first sign that the order flow may be shifting from bullish to bearish. At this point, this lower low here becomes the new break of structure level, while the previous swing high becomes the change of character level. This is because the swing high is now the key level that needs to be broken for the market to shift back into a bullish order flow. However, we shouldn't assume the trend has flipped bearish just yet, because the change of character might only be a liquidity sweep. To confirm a true downtrend, we need to see price break below the break of structure level. So, in summary, a break of structure confirms trend continuation, while a change of character signals a possible reversal in order flow. Now, moving on to the next step. But before we continue, let's talk about the next big thing in crypto. Introducing the Pepe meme coin, a fast-rising crypto project that is gaining serious traction and could be the next big thing in the crypto space. The Pepe meme's presale is already making headlines. So far, it has raised over $3 million before even hitting the open market. That's a massive show of early demand. And when it comes to meme coins, momentum in the beginning often sets the stage for explosive moves later on. But what's even crazier is the community backing this token. On Twitter, Pepe Meme already boasts of 3.3 million organic followers. That's nearly 5 times bigger than the original Pepe coin, which sits at around 700,000. In the meme coin world, community is everything, and this kind of growth suggests serious traction. Now here's where things get really interesting. Elon Musk has mentioned Pepe again. Whenever Elon tweets or hints at a meme coin, we all see what happens. The meme will move the markets. And this time, his reference isn't just a passing joke. It's tied into this growing narrative around Pepe Meme. For investors, this is fuel for speculation. Elon's influence has turned coins like Doge and Shiba Inu into household names, and Pepe Meme could be next in line. So, how does it actually work? First is smart presale. This means the more you buy, the more tokens you get, rewarding early adopters. I am very bullish on this project. As you can see on my wallet here, I have bought over 100 billion Pepe Meme tokens. And right here on the Pepe unit balance, I have over 400 million Pepe units. And secondly, the bonus airdrop. Simply holding earns you more over time. This structure incentivizes long-term holding instead of quick dumping, a strategy that many meme coins fail to implement. And here's a real example. Someone who bought Pepe early on Ethereum with just a small investment is now sitting on millions. That's the kind of 1,000x story meme coin investors are chasing. Imagine this. You put in $10,000 at the presale. If Pepe Meme follows the same 1,000x trajectory as its predecessor, that $10,000 could turn into $10 million. Of course, these are speculative scenarios, but this is exactly the dream meme coins sell. There's also a strong indication that the original Pepe team on Ethereum may be pivoting by launching this new version on Solana. That move could help revitalize the project and attract new liquidity into the ecosystem. On top of that, with a community this size, listings on major exchanges feel almost inevitable. The presale and IDO are wrapping up, which means the window of opportunity is closing fast. And if big exchanges step in, the hype cycle could kick into overdrive. So, if you want to invest in this project, just click on this buy button, then connect your wallet, and then you can purchase the amount you are comfortable with. If you're interested, I will leave the official link in the description, along with more research so you can dig deeper. Remember, this is not financial advice. Always do your own research before investing. Now, back to the video. Step number 3 is understanding how external range liquidity relates to internal range liquidity. In this example, the market is in an uptrend, confirmed by a bullish break of structure as price moved beyond the previous swing high. Now, with this new bullish swing established, we can now identify the current external range liquidity levels. Since the structure here is bullish, we can anticipate price aiming for the upper buy-side liquidity level. However, to achieve this, the market first needs to establish support that can drive the next bullish move. This is where we look back into the previous swing for bullish internal range liquidity, often appearing as a bullish fair value gap. The market can then use this as momentum to break through the buy-side external range liquidity. In other words, the market tapped into internal range liquidity, using it as fuel to attack the external range liquidity. This movement has now formed a new swing, complete with its own external range liquidity levels. Now, if we expect the uptrend to continue, we should once again look inside this new swing for a bullish fair value gap, which the price will use as fuel for the next upward leg. In summary, during an uptrend, impulsive moves typically leave behind internal range liquidity in the form of bullish fair value gaps. These gaps can later be used by the market to drive price through buy-side external range liquidity and establish new higher highs. For downtrends, the concept works the same way, but in reverse. If we anticipate price breaking below the sell-side external range liquidity, we need to examine the prior impulsive bearish swing for internal range liquidity, often appearing as a bearish fair value gap. which will fuel price to aim for the sell-side external range liquidity. This illustrates the connection between internal and external range liquidity and how trending moves are built on the chart. It's crucial to keep this in mind during technical analysis, because when internal range liquidity fails to hold, it's an early indication that the market may target the change of character level, potentially signaling a complete trend reversal. The next step is to understand the difference between liquidity runs and liquidity sweeps, and more importantly, how to anticipate which one will occur. When price reaches an external range liquidity level, whether a previous swing high or swing low, it has two possible outcomes. It can either continue in the same direction, which we call a liquidity run, or it can reverse from there, which is known as a liquidity sweep. While this may sound so straightforward, predicting how price will react at these liquidity levels is one of the biggest challenges traders face. Let's begin by examining liquidity runs. In this example, we have a swing high acting as the current external range liquidity that price is targeting. Price then pushes upward and closes above the level. However, when this happens, it isn't yet considered a liquidity run. It has only created a breakout. What we need to see is another bullish candle, forming a fair value gap that overlaps the breakout of the external range liquidity. This is important because for the bullish move to continue, the market must establish an internal range liquidity that can serve as support during the next retracement. Now let's move on to liquidity sweeps. In this case, we have another swing high acting as the liquidity target. But this time, when price broke the level, it failed to close above it, but reversed immediately, rejecting the level with candlewick. This signals significant weakness from buyers and creates what is commonly known as a fakeout, a strong indication that a liquidity sweep is taking place. From this point, we anticipate a shift in order flow, which means we should begin looking for selling opportunities. However, we won't consider entering short positions just yet. And that is because, based on the market structure concepts we covered earlier, we first need to see price break below the previous swing low, creating a change of character, which serves as the second confirmation of a shift in order flow. Then the final factor to look out for is whether this bearish leg creates a bearish fair value gap, because that is what will serve as a resistance to drive price lower, leading to a new break of structure and confirming that the market has officially shifted into bearish order flow. This is the typical setup we often see when the market forms a liquidity sweep. The key point to remember is that we shouldn't take trades based solely on price's reaction to the external range liquidity. Rather, we need to focus on how the market structure develops and look for entries only once a clear directional bias is established. If you found this video helpful, don't forget to hit the like button and also comment what trading concept you'd like to see us cover next.